Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. Today's episode, it's going to be a little less directly talking about mortgages and mortgage rates, though it will definitely overlap with that subject. So if you're really just interested in that, maybe this isn't the video for you. However, if you're interested in kind of high level economics, nation, world order type of subjects and history, then I think you'll enjoy this episode in particular. So I'm mainly going to focus on one particular theory. This is where I heard of it, so that's what I'm going to kind of focus on and reference because it's a very laid out and kind of systematic theory. And that is Ray Dalio's book. He showed to you. It's called The Changing World Order. And basically, it talks about historically different nations that rise and fall, different kind of economic and general cycles, and what cycle he sees the US and certain other countries in right now, and also how some of the current events going on with Iran in particular tie into this theory. Let me start with going through the three world currencies of the market-based economy style. So initially you had in the 16th and 17th century the Dutch era, where they had the world currency in the guilder. They had the stock exchange in Amsterdam, and they were the most dominant power at that time. Then that gave way to the British, who had the pound as the world currency, and that lasted really until World War II, when the US took over and the dollar became the world currency, and that's where we stand today. So the basic cycle, it starts as you're kind of the up-and-comer, where the population is kind of hungry underdogs, and you get to this point where you are the dominant power. Usually it is things like education that precedes you actually getting there. People are hungry, people are really seeking education, and then through that you build these technologies that advance your population and also create financial wealth for that nation. And it's usually the world currency that comes last as part of this equation. And conversely, when you're on the other side of it, when you're at the end of that cycle, it's the reserve currency that's the last to go. You'll see things like declining education and declining technical innovation. That's going to leave before you ultimately lose the reserve currency status. And what usually happens at that stage, which, if you haven't guessed, Ray Dalio believes the US is in right now, a country that has the world currency, you have a huge advantage in that you can print more. So if you get into any economic troubles, which is always part of this last stage of the cycles, you just print more currency. So inevitably, when things get tough, that country prints more of their currency, devaluing the currency. And it's just kind of this vicious cycle where they get further and further indebted until it kind of bursts. And typically, the end of the cycle is either a revolution or like just change in government style. It is most often a violent change or just general war. But it's worth mentioning, in the US, the transition from the period right before World War II, where the Great Depression was kind of the end to the previous cycle, and then starting with FDR and then with World War II, you had this largely nonviolent, at least internally nonviolent, obviously World War II, very violent, transition to this new cycle. So let's get to how this relates to mortgage rates. As a country starts to raise the level of debt, it becomes less desirable to invest in that country. And with the US in particular, treasury prices are such a important part of our economy. And hugely important to mortgages, because outside of one-off kind of random situations like when Trump had Fannie Mae buy $200 billion in mortgage-backed securities, which affected mortgage-backed security prices, but not treasury bonds. Outside of that, general market activity is always going to be pretty much perfectly directional between mortgage rates and treasury prices. As treasury prices go up, mortgage rates go up. As treasury prices go down, mortgage rates go down. So as countries and people, but it's largely countries that buy US treasuries, as they perceive their investment as less safe, as the US rate keeps printing and raises the level of debt, and it becomes less and less likely that they will be able to pay back that debt, those countries are going to pull back investment and invest in countries that they view are more of a sure thing. And that's where you start to see these rises in mortgage rates. Now, we're still relatively new to this conflict with Iran, but it's worth mentioning mortgage rates have steadily climbed since that has started. And one thing that I've noticed that this situation has made apparent to me is that the US, compared to other countries like Iran, China, they're much less willing to accept any kind of pain economically than these other countries. You can say it's partly due to the government, the nature of the government, more of a totalitarian dominant position versus democracy. But regardless of the reasons why, the US population is just not equipped to handle any kind of disruption right now. And Iran is using that to their advantage. Now, what Trump and his administration does to try to bring gas prices down, they've already done a few things, but ultimately they're going to have to make a choice of, do you continue this war? And inevitably that's going to lead to much higher gas prices. Like, there's just no way that doesn't happen if then. Or do they back out of the war, and that looks weak from a worldwide perspective? It devalues our ties to certain allies. It's not a great position to be in. And if the first option happens, how long does this last? And how dramatically does this speed up the timeline of countries pulling out of US treasuries, of the US racking up more debt, and us getting to a point? Because typically what happens as like a breaking point economically is when the country that is now racking up debt, that's the world power, puts in economic sanctions, like where you can't move your money out of the US, for example, where you aren't able to withdraw money from your accounts, raising taxes dramatically, things like that. And that's usually where the breaking point happens. And then you have this big conflict. A new order is what ends up happening eventually. It's just a question of whether that conflict is violent or just kind of a systematic shift. I don't know what's going to happen with the US. Certainly what's going on in Iran is really a unique market situation where there really hasn't been any data released to explain the change in mortgage prices, but the headlines are 100% driving things. And I expect that will continue until at least we get some economic data next month showing the numbers in March. But I think the real shift is going to have to be like a ceasefire or some kind of major shift in the war with Iran. Otherwise, I expect mortgage rates are just going to keep going up and to the right. A longer video than usual, but I had a lot of thoughts on the topic and wanted to put them out there. We'll certainly continue the short form videos, but if you have any questions on this, feel free to shoot them below or call, text, or email me. Thanks for tuning in, and I will see you next time.